Well, it was a monumental gain for the Australian share market today, but there are a few potential storms on the horizon, and until they're past, I don't think bullish investors can sit too comfortably. Hi there everyone, welcome to the Traders Circle Weekly Market Update. It is Tuesday the 25th of June 2024, and before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. So the two big events, the two potential storms this week are Australian CPI and the US PCE, or Private Consumption Expenditure reports. CPI will come out locally tomorrow at 11:30 a.m. Australian Eastern Standard Time, and PCE will come out on Friday night after our market is closed. The key one for Australia will obviously be our local CPI, or inflation report, and it is actually expected to show inflation dropping by about 0.2% for the month. But that'll still be a very, very high headline CPI rate of 3.8% year on year. It is a little bit worrying because recent comments from the RBA suggest that we're not out of the woods in terms of rate rises. And indeed, Australian inflation has been tracking a lot higher than, parts of the world that have looked at cutting, the US, for example, or elsewhere in the Western world. So with CPI at 3.8%, that is certainly not cut territory. And it leans more towards rate rise territory. Now the RBA will almost certainly wait for next month's full June quarter inflation report before deciding on doing anything. But if that June quarter inflation report surprises even slightly to the upside, which may be triggered by a slightly higher CPI reading this week, well then we are likely to see a RBA rate rise come August. And I think that's a big concern for our market. If we were to see another rate rise, I do think it'd dent some of the recent positive sentiment that we've had. Especially given that the rest of the world is starting to look at rate cuts. US PCE data, that's the Fed's chosen measure of inflation, and that is expected to come down a reasonable amount after being fairly sticky for the past 3 months. That will potentially pave the way towards a US rate cut in September. And I do think that sort of creates a bit of contrast between, the different rate outlooks between our Reserve Bank, who may be looking to rise further, and the US Fed, who may be looking to cut. It also sort of goes some way in explaining the divergence that we've seen between US shares and Australian shares. Obviously, US shares extremely bullish, and Australian shares have really struggled to set fresh highs. I guess there are plenty of other potential explanations for that, and perhaps the most important one being that Australian shares are almost certain to earn less this year than they earned last year, and it's really hard to justify, further additional gains in declining earnings environment. Also we've seen iron ore, probably the most important commodity for our market, head lower recently. But I do think a big part of our underperformance comes to the divergent inflation outlook. So that CPI data on Wednesday morning, 11:30 a.m., that's going to be a big one. Any surprise to the upside, even an inline reading, I don't think will be a good thing for the Australian stock market, especially given the sort of strong rebound that we've seen over the past session. PCE for the US, on the other hand, if it does come in as expected, it does sort of pave the way for those rate cuts coming towards the end of the year. So those are the interest rate moves I wanted to talk about. Maybe a bit of divergence being seen between here in Australia and there in the US. And I do think that, the market is really underpricing the likelihood of another Australian rate rise. Just reading comments from economist David Bassanese, he thinks that there's about a 40% chance of a rate rise in August locally. And if you look at the performance of our market, especially today as we head into that CPI reading, it's clear that the market doesn't hold too much weight in another rate rise scenario. The reality is, though, that our data has been inflationary, and if it continues to do so, the RBA will have no choice other than to lift interest rates further. The other thing I wanted to touch on this week is iron ore. Iron ore has been falling quite strongly for about a month now, but it has shown a little bit of sign of life today, in today's session at the very least, with prices stabilizing after falling for the past few sessions. I'm a bit surprised by just how strong the miners' response to this was, with most of the miners jumping strongly in today's trading session, despite iron ore really only ticking higher very slightly. So I do think it's going to be a key flashpoint to watch, whether or not we see iron ore rebound from here or not. It has come off an awful lot. And you have to assume that given that we're starting to see other commodities rally, given that we're starting to see share markets push back to highs, maybe we will see a bit of stability in the iron ore market as well. Definitely something to watch over the coming week or so, because if it does bottom out here, there is a lot of potential room to the upside in these iron ore miners, and that could be the driving force that our XGO needs to push back towards its own highs, because it's the banks that have been doing all the heavy lifting, and the banks are extremely overpriced at the moment. CBA is perhaps the most expensive bank on earth. The other banks aren't far behind, and if you look, on a sort of earnings basis or an earnings growth basis or a dividend yield basis, using financial valuations, it's extremely difficult to justify the current prices on the banks. Indeed, if you look at the broker targets, and they are notoriously unreliable, especially in the short term, most of them have the banks at a broker target 20 to 30% below the current share price. So like I said, if our market is to go to new highs or back to the old highs, probably the iron ore miners will at least have to do some part of the lifting. So let's have a quick look at the charts for this week, guys. This is the XGO, the top 200 stocks on our market, and it has had a very, very strong session today. A bit out of nowhere, to be honest, especially considering that the US S&P 500 closed lower overnight. It was, however, the technology space that dragged their market lower, and our market doesn't have any notable technology stocks, at least very, very few in the top 20 that can sort of drive our own market higher. So given that it was the technology stocks that dragged the US down, just about every other US sector closed higher, and that might have been the signal our market was looking for to start pushing back up. We had a very strong jump. We jumped through 7,800 and we continued further higher, and we now look like heading towards that sort of 7,850, 7,860 level that we reached at the start of the month. And to be honest, it doesn't look like we're too far off that level at all. We could even reach it before CPI reading comes out tomorrow. If we kind of clips that high, we're then starting to look back to the all-time high, the resistance at 7,900. It has to be said that our market is extremely expensive up at those levels. However, that doesn't mean that we won't go a bit further. What I will say though is that we will certainly be trading below those levels at some point, even if we do eclipse them. Like I said earlier, our market is expected to earn less per share this year than it was last year. The interest rate outlook is probably a bit more negative now than it was last year, and that we're forecasting fewer rate cuts. And so I think it is very difficult to justify too much further upside movement, but that doesn't mean that it won't happen. One of the key sort of driving factors of global share market rallies, I touched on it last week, was money printing in the US. Now, a lot of people equate money printing with quantitative easing, but that's really not the case. Money printing is actually borrowing. It's borrowing that creates new money. And in the US at the moment, we're seeing record government deficits. They're basically borrowing money at a faster rate than they ever have before, and that is essentially printing money that is powering markets higher. So the statistic I've read is about $1 trillion US every 100 days. I don't think it's getting any smaller. And that new money creation is a large part of why we've seen markets push up as they have. So let's have a look at the US market now as well. They're also up around their highs, although they have seen a little bit of selling over the past few sessions. As I mentioned previously, that's been pretty much confined to the technology stocks. They perhaps ran a bit too hard and starting to see some profit taking come in. For the US S&P 500, the key level to watch is 5,500 index points. Markets do love round numbers, so this could prove to be a bit of a short-term resistance level. If we do see a pullback, I'd be looking towards the previous resistance at 53.75, and that may now act as support. If that breaks, they could be going back towards the longer-term uptrend line. Over a longer-term period, though, they are in a very strong uptrend, and you have to assume that that uptrend is going to continue. So if it does come back to trend, you have to assume it's going to bounce and then set a new high above 5,500. They are at very, very high valuations. Again, they will probably be trading at levels below these levels in the future, but it doesn't mean they won't set fresh highs in the interim. So I will wrap it up there for this week, guys. A bit of a shorter one. At this point, we're just waiting for the key data events: CPI tomorrow, US PCE on Friday, and who knows? Maybe things will look quite a bit different next week. But otherwise, it looks like the trend is continuing. So hopefully you guys enjoyed. If you did, give us some love, and we'll see you in the next one.